Hey guys, welcome to my channel. My name is Bob and today I want to talk about how to start investing. I get a lot of questions about how should I start, where should I start, and it makes sense. Starting investing can be quite daunting and there's so much information out there. So in this video we'll go over everything you need to do to prepare and everything you need to do once you start investing. And the first thing is already about investing, and we're talking about investing, not trading. Trading is buying and selling stocks, options, whatever, and maybe selling it after a few hours or a few days. Investing is doing your research. Where do I believe there's a lot of growth potential in the next years or maybe even decades? Put your money in there, invest it, and keep it in there. And in order to do this, which brings us to the second point, you need to have this backup fund. We're investing, putting our money away for a long time. So the last thing that we want is that we need some cash and we need to start selling off our investments. If we're into index trackers and something like last year happened where the stock market just plummeted, you don't want to have to sell with a loss because you need some cash. So have 3 to 6 months of cash where if all of your income goes away, you make $0, you can still live for 3 to 6 months. It should cover all of your expenses, and that gives you 3 to 6 months to start generating a cash flow again so you can keep your money in there, the investment. So that is very, very important. So we have our little backup fund now. We know that we're gonna invest, and now we need to do research. And our research consists of 2 things. First of all, you should never ever invest into something that you don't understand. Don't buy stocks or crypto just because someone says, oh, Bitcoin is gonna go through the roof, or oh, Tesla is gonna go through the roof. Sure, if they told you this a year ago, they were right, but don't just invest because someone tells you to invest. Do your research, understand the product and the business you're investing into, and then make your decision. And other than that, there's more research you need to do. Start reading books, start watching videos like these and listening to podcasts about investing in general. You want to educate yourself as much as possible to know about there's so many things you can do when it comes to investing, and you want to increase your knowledge because only then you can really make proper decisions. Okay, so we've done our research, we have this little backup fund, now we need to choose a broker. And a broker is a bank or a company that allows you to buy and sell stocks, bonds, index trackers, all of those things. The general rule with investing is we want to have the cost as low as possible. This has a major impact on the compounding, which we'll get into in a bit. So we don't want to have someone managing our investments. Someone managing your investment will really make a big dent into your profits. But we also don't want to go too cheap. There's brokers out there which are basically free. You can buy and sell and keep your money in there almost for free, but they need to make money. So they need to take risks in other ways. And since we want to have our money in there for a very long time, we want to be 100% sure that the broker that we're using is really reliable, has hopefully a big bank or a big company backing it, and that your money is safe there. So I would rather pay a few dollars more for buying my stocks or whatever and knowing that it's safe for 10, 20, 30 years to stay there rather than saving a little bit and taking a risk. So again, you need to do research for a broker. There's different brokers in every country. You probably need to have one in your country. Do your research, make sure they're very cost effective, but also that they're backed by a big company so you don't have any risk. So we have the research, we have the war fund, we picked the broker, we've sent money to your account, now it is time to invest. And I believe that the easiest thing to do in the beginning is to go for some index funds. Again, index funds give an amazing return on investment long term. They might pay some dividends, but they're also relatively easy to understand. An index fund, for example, of the S&P 500, is just a little piece of every single company within the S&P 500. And trust me, you and I, if we're going to do stock picking, it's going to be very hard to beat the market long term. So why not just follow the market, because we know that this will bring us roughly 7% return on investment. It's a very nice way to just get started, to understand what happens if the stock prices go up, what happens when the stock prices go down, especially mentally to me as a person. And it's just a nice way to sort of ease into it. And that mentally brings us to the next point. You need to cut out all emotions when it comes to investing. And that means that if the stock prices just go down and down and down, a lot of people will panic, emotions will take over, and they will sell with a loss. And Warren Buffett once said, get greedy when others get fearful, and get fearful when others get greedy. And last March was a perfect example of this. Stocks were booming prior to the whole situation in the world right now. Around March, people started to sell and the stock prices started to drop. And a lot of people got scared, like, oh no, it's dropping, so I need to sell now as well, which just means that it's going to drop more and more, which means more people are panicking and start selling, maybe because they need the money, they didn't have the war fund. And that was the perfect moment to buy. The big winners of last year were the people who bought in March and April. I know this is super difficult. I remember opening, my broker app and seeing the negative, what I virtually lost that year. But I also knew this is the moment that I have to start buying more. So in March, April, and even May, I bought more than what I would normally buy in a year or 2 years, just because I thought it was an amazing opportunity. And by doing this, by not letting emotions drive me, but by actually taking some time, taking a few breaths and thinking what is the best thing to do now, I managed to get an amazing result last year despite everything that was going on. So really know that you shouldn't act out of emotion. So we have all of that covered now. Now the question is, what type of investor are you? There's a lot of different types, and the main thing that you need to decide is what risk am I willing to take? As always, the higher the risk, the higher the potential reward, but you can also lose a lot of money. So we are investing, we're doing it more for long term. So how much risk are you willing to take with your investment? And that's different for everyone. I myself am a pretty conservative investor. So I have 1/3 of my investment in real estate, 1/3 in stocks and bonds or index trackers and bonds, and then 1/3 in cash. A bit of crypto, but that's a different video. Maybe you are a bit younger than me. Maybe, it also depends on your situation, your life. You don't have a family to take care of, maybe not too much high cost. I mean, I also have employees which I need to pay. So I need to be relatively safe with that. And it's also just my character. Maybe you are not in that situation. Maybe you like to take more risk. So based on your risk assessment of yourself, you can either decide to actually start picking stocks now. So do go for individual stocks. Again, it's very hard to outperform the market, but if you do your research, and if you would have bought Tesla, for example, last year you could have made a killing right now, but you could have also lost quite a bit of money. So decide what risk profile you have and decide how you want to balance your portfolio. So maybe for you, it might be 50% in index trackers, 30% into individual stocks, and maybe another 20% in crypto, for example. So that is just all up to you. Decide what kind of investor you are. Now, once we have all of that done, and you have this, now it's very important to start dollar averaging. And this means that you're going to be adding money to your account and buying the portfolio, just buying more of the portfolio you have every single either week, month, whatever works for you. For me, every first Monday of the month, I basically send the same amount of money to my brokerage account, and then I just buy a portion of everything that I have in there. So I keep adding. And this way, I don't have to time the market. I will have the average of the entire year, the average price of the entire year. A friend of mine, I spoke to him probably in October, and he was really saying, Bob, I really want to start investing, but the market is so high, I shouldn't. And I convinced him to actually start investing just by, a small portion and keep adding. And since then, the market has gone up another 8%. So that's an 8% he could have missed. Here's a fun thing. If you miss the 3 best days of the year, you will probably have a 1 to 2% return. But if you are just averaging, you will have an average of 7% return. So just by doing that, by just buying, you're still better off than trying to time the markets, which honestly, we just can't do that. It's just too difficult. So pick a specific time. It could also be every week, can be every month, maybe 4 times a year, whatever works for you, where you send money to your account and buy the things that you decided to invest in for the long term. Now, there's 2 more things we need to discuss. One is that you need to understand that dividend is amazing. Dividend is often said to be the best passive income. So dividend is, I buy a piece of your company, a share, and with that, I now get a profit share of your company as well. Index funds also pay out dividends, but if we look at stocks, sometimes people pick only stocks which pay 6, 7, 8% dividend. Now, why would a business pay you 8% basically interest on what you put in? It's because they need your money. They need your money to grow. They need your money because they have debt. They need your money for some reason. So again, that means it is a higher risk. And sure, there's a potential higher reward, but you have to realize that the reason they give you a super high dividend is just because they need your money. They wouldn't do that if they don't need your money that badly. They would probably invest that money in buying back stocks, which is another tactic a lot of businesses are using. So again, this should fit your risk profile, but it's something you have to be aware of. And the last thing is compounding. So as I explained earlier, compounding means that all the money, all the returns that you're making and all the dividend that you're getting, you should be reinvesting. Don't get it out, reinvest it, because that way $100 becomes $107, but next year you don't make 7% out of $100, but out of $107. So that starts to multiply and multiply, and that's why your portfolio will start to grow like this. It goes faster and faster until you get amazing returns. And sure, there will be years that are bad, but just reinvesting your dividends, getting your cost as low as possible again, but still without taking too much risk, that's going to be a major impact in the overall return long term. So just to recap really fast, first of all, we're speaking about investing, not trading. Second of all, do your research. What do you want to invest in? How does it work in your country? Number 3 is, do research in terms of what is investing, what possibilities are there. Always keep learning. Pick your broker, and from that start with some index funds, see what kind of risk you want to be taking, use dollar averaging. Maybe you want to watch this twice. I know there was a lot in here, but it is super important. So I hope it was of value. If you watched all the way to the end, you might as well subscribe, let me know in the comments what you are investing in and what your thoughts are in this, and I will see you in the next one.